The day of liberation, as Trump called it, was the day that Trump announced tariffs on over 90 countries around the world, including a pair of sub-Antarctic islands home to thousands of penguins. The apparent ridiculousness of Trump's policies have been mocked as the consequence of a madman in power that serves no sound economic objective. However, a more nuanced economic analysis of capitalism, how it operates, and its innate contradictions reveal that the seemingly absurd and erratic policies of the Trump administration actually do serve some key fundamental objectives for the capitalist ruling class. For instance, as soon as Trump announced the tariffs, the market crashed, wiping out trillions of dollars in the value of stocks. And although Trump has now issued a 90-day temporary pause on the vast majority of these tariffs and has even just announced that he plans to significantly reduce the tariffs he imposed on China, the sheer instability he has created in the market has sparked global fears for recession and further crashes.
Now, there's been chaos on global markets overnight on a scale not seen since the depths of the COVID pandemic. US markets have suffered the heaviest losses, with trillions of dollars wiped in the wake of Donald Trump's wide-ranging tariffs.
However, this is the thing. Market instability and recessions are vital tools for the world's largest multinational corporations, meaning the capitalist ruling class, to strengthen their market position by monopolizing the market so as to increase profits dramatically for the world's wealthiest. Therefore, in this video, we will assess the true objectives behind Trump's tariffs policy and to what extent it shall achieve its stated aim. Firstly, as tariffs will increase the price of imports and supply lines, this will generate a stock market crash, as the one we saw right after Trump first announced his tariffs. Now, when a stock market crash occurs, many smaller and/or weaker companies see their stock prices plummet, meaning that their company stock loses value dramatically, destroying their business and driving them out of the market. This makes them prime targets for acquisitions by large multinational corporations who have strong cash reserves, aka profits, and can thus withstand market crashes. As they do, they swallow up the weakest companies who are unable to withstand the market crash by buying up competitors, patents, or entire companies at dirt cheap bargain prices, and thus consolidating their market hegemony. The 2008 financial crisis that itself was created by the world's largest financial institutions is a prime example of this, as the Bank of America acquired Merrill Lynch at a steep discount, and JP Morgan Chase bought Bear Stearns for a fraction of its previous value. Similarly, after the dot-com crash in 2000, companies like Amazon and Google emerged stronger by absorbing the market share from failed competitors, hence wiping out competition and monopolizing the market. Now, by monopolizing the market share, this allows the world's largest corporations to control global markets, coercing them to yield at will. This occurs in numerous different ways, such as via pricing power, which allows the largest corporations to engage in predatory pricing by selling below the cost of rivals until rival companies and smaller or medium-sized businesses go bankrupt, further allowing them to appropriate more of the market share. Once this occurs, the same multinationals will raise prices at will, hence manipulating supply and demand, as well as purchasing power, all of which further allow the same multinational corporations to deter competition and consolidate power. This is precisely why Amazon controls over 50% of US e-commerce, and Apple and Google take 30% cuts from app stores due to monopoly tax. It is worth noting at this stage that by driving smaller and/or weaker companies out of business, this increases the army labor reserve that itself allows for the very same multinationals to be able to exploit the expanding and desperate labor force so as to keep wages low, hence preserving the surplus value, aka the profits, of the world's largest and most powerful corporations. Now, this brings me to my next point. A stock market crash and global recession allows for the world's largest and most powerful corporations to purchase cheap stock buybacks. Now, what is this and how does it work? When stock prices collapse, corporations with large cash reserves can buy back their own shares from investors at a discount, which serves capital in several ways. Firstly, as large multinational corporations buy back their shares, they artificially increase the value of their shares by making them scarcer, thus boosting the earnings per share of the company and the shareholder value. This meretriciously makes the company appear more profitable than it actually is, as the value of said shares increases in a form of direct market manipulation. Consequently, the artificially inflated prices of stocks encourages stock market speculation that attracts investors who will pour money into financial assets, prophylactically preserving the stock market bubble that keeps the US economy afloat whilst generating billions, if not trillions, in profits for the world's largest corporations. What's more, is that as the earnings per share for existing shareholders significantly increases, this effectively means that existing shareholders would make significant returns. So, who are these shareholders? Well, according to data published by the Federal Reserve, the top 10% of Americans own 93% of the stocks in the US market, thus meaning that the increase in earnings per share generates billions in profits for the world's richest at the expense of the average working class American. It is therefore for this reason that many experts have long argued that the stock buyback mechanism has become a means of exorbitant wealth transfer from the average citizen to the 1%, making the rich richer, the poor poorer, destroying competition, buying out the market, and monopolizing wealth so as to facilitate greater wealth inequality. This market manipulation, or finance engineering as some call it, is the reason why stock repurchasing was actually illegal until 1982. Having stated all the above, this is precisely the reason why, following the stock market crash that occurred after Trump's announcement of global tariffs that wiped out $10 trillion of global stock prices, Trump was seen in a video claiming that this is a great time to buy, and that some of his billionaire friends, such as Charles Schwab, founder of the Charles Schwab Corporation, a multinational financial services giant, made $2.5 billion in just the first day after the crash occurred.
This is Charles Schwab. It's not just a company, it's actually an individual. And he made $2.5 billion today, and he made $900 million. He's a financial.
Now, another means by which stock repurchases aids in the mass proliferation of profits for the ruling class is that it is a more effective way for shareholders to avoid paying tax. Usually, if you're a shareholder who receives dividends on your shares, you must pay tax on it annually, even if you don't sell your stock. This ranges between 15 to 20% if held long term, and this is in addition to the corporate tax that the company has to pay. Consequently, what this means is that dividends gets taxed twice, corporate tax first, then shareholders pay tax on dividends. With stock buybacks, however, you do not have to pay annual tax on dividends until you sell those stocks. Therefore, the IRS will only get a cut off of that money when the shareholder decides to sell, and there will only be tax on the capital gains, meaning the profits, of that sale. Why this matters? Well, as already stated, when these multinational corporations buy back their stocks from investors for a much cheaper price, this then immediately increases the value and prices of their stocks due to artificial scarcity. The value of their stocks hence skyrockets, and because these stocks are now considered buybacks, the shareholders, which in this case accounts for the US top 10%, no longer have to pay tax on their dividends, meaning that they have quadrupled their profits by artificially raising prices, and as such their dividends, with no annual tax on that dividends, meaning they make 100% profits. Additionally, with stock buybacks, these billionaire shareholders will only pay tax on capital gains made when they finally decide to sell their shares. This means that these multinationals are able to buy back their shares for a discount, increase their value instantly, and then choose to sell shares when it's most profitable to them, and will only pay tax on their profits made from their sales, saving these corporations billions. In fact, according to JP Morgan, following the 2008 crisis, the world's largest corporations returned over $5 trillion to shareholders via corporate buybacks. Similarly, in 2019, Apple and Microsoft collectively spent over $120 billion in stock buybacks at the time of the repo market crash, which resulted in revenue growth of 47% for Apple and 68% for Microsoft. Most importantly, their market capitalization, or market cap as it is often called, which is the total value of a company's shares, grew by 200% for Apple and 133% for Microsoft following the 2019 crisis. At the same time, financial institutions such as JP Morgan, Goldman Sachs, and the Bank of America also spent over $200 billion in stock buybacks that resulted in market cap growths of 200% for each one of these financial institutions. And in fact, these same corporations have each seen over 600% growth in market capitalization since the 2008 crisis, meaning that profits on shares that are owned by the oligarchy have grown by over 600% thanks to crises that they themselves manufactured, whilst the working class globally suffered the cost in the form of austerity. Similarly, according to reports published this week, the companies that recorded the greatest loss to their stock value were Apple, with losses of more than $500 billion, Nvidia, with $385 billion, Amazon, with $262 billion, and with the rest all being part of the Magnificent Seven. Thus, the Magnificent Seven, who were the ones to see the greatest hit to their stock values due to the Trump Liberation Day tariffs, will now be able to use their enormous cash reserves to purchase stock buybacks, artificially inflating their value of their shares tax-free, that in future shall see their market cap and profits proliferate dramatically, whilst they simultaneously continue to monopolize the market, driving smaller and weaker businesses into early bankruptcy. In the meantime, small and medium sized businesses will see their value deteriorate dramatically without the cash reserves to safeguard them. It is important to note at this stage that this comes at a particularly ideal time for the capitalist class, given the DeepSeek phenomenon and its threat to the artificially inflated financial markets, which are primarily inflamed by overvalued tech stocks. Now, in addition to this, Trump is also introducing a new tax bill to reduce corporate tax from 21% to 17%. He's using this newly imposed tariffs, which themselves are a form of tax, as a means to justify the reduction in corporate tax cuts, claiming that it will ease the burden on corporations. However, as we saw in 2017, there are copious issues with this economic reasoning. For context, in 2017, Trump had reduced corporate tax from 35% to 21%, something that did not alter under the Biden administration. Just food for thought. Now, according to a report published by Groundwork Collaborative, an economics think tank, in 2017, corporations spent more than 3 times as much on share buybacks than they did on taxes, using the vast savings that they made from the 2017 Donald Trump tax cuts as cash reserves in order to supercharge purchases that enriched investors instead of lowering prices on goods essential to daily life. Some of the corporations that were outlined in the report would include PepsiCo, Comcast, and our favorite, United Healthcare. Therefore, the potential tax cuts come at an ideal time, as it will allow the world's largest corporations to increase their cash reserves, strengthening their position to withstand a recession that in turn will permit them to buy out the smaller and weaker corporations that will be unable to withstand the market fluctuations, exorbitant tariffs, and the inflation these tariffs shall cause, hence allowing the largest corporations to monopolize their market share, whilst simultaneously these same multinationals shall accumulate enough cash reserves to buy back stocks that will maximize profits for the world's richest. In the interim, small to medium-sized businesses shall collapse, with 11.5% of US firms classified as zombie corporations, meaning that they pay more in debt than they actually earn. This shall exacerbate an ever-growing desperate labor force, exposing them to slave wages that will serve the profit margins of the elite, whilst inflation will diminish their purchasing power and deteriorate their material conditions even more so. Now, the inflation caused by Trump's potential tariffs will ultimately affect international dollar-denominated debt, which currently stands at 64% of the world debt. This means that servicing that debt will increase dramatically for the American working class, as well as the dollar-denominated debt-ridden countries. This risks a global recession that shall ultimately cause bond market instability. Now, just as in the case with the stock market, an unstable bond market becomes a source for major profits and wealth transfers for the bourgeoisie, and this is done in several ways. Firstly, volatility creates arbitrage opportunities, where finance firms in the form of hedge funds and investment banks exploit price differences between markets by using the debt crisis created by inflation to buy cheap distressed assets in one country and selling it elsewhere. One classic example of this are the vulture funds and their debt trading following Argentina's 2001 sovereign debt crisis, where over $100 billion in bonds collapsed, and many institutional investors, such as pension funds and banks, sold their bonds at huge losses. This allowed vulture funds, such as Elliott Management and NML Capital, to swoop in and buy these bonds for dirt cheap. Argentina later offered haircuts, which are partial repayments, to these creditors. However, the vulture funds rejected the deal and sued Argentina for full repayment plus interest by using the US court system. As a result, these vulture funds made enormous profits, with both Elliott Management and NML Capital making 1,000% returns on their investment. In the meantime, Argentina had to cut social spending to pay them, impoverishing the Argentinian people so as to pay $4.6 billion back to these vulture funds. In addition to arbitrage, these hedge funds engage in another trading strategy during a crisis known as shorting bonds. Shorting bonds are a high stakes financial strategy where investors bet against a borrower's ability to repay debt by profiting when bond prices fall or when default occurs. The way this works is that these investors anticipate that a crisis will happen that shall cause these countries or corporations to default on their payment. They therefore buy bonds from, say, a dollar denominated debt ridden country, whilst the price is still at good market value, and sell it instantly. When the crash occurs due to inflation, for instance, the bonds then lose value dramatically, allowing these vulture funds to come in and buy the same bonds for much cheaper, thus making substantial profits between the initial selling price and the repurchasing price. Another method that will allow the financiers to capitalize off of bond market instability is a mechanism known as credit default swaps, or CDS. Instead of shorting directly, traders can buy CDS contracts, which are usually issued by banks. And if a bond defaults or prices crash, the CDS contract guarantees the banks must pay the full face value of the bond. For example, if a hedge fund pays a premium of, say, 5% per year to insure against Argentina defaulting, when Argentina does default, the CDS seller, often a bank, must pay the full value of the bond, which could be, say, $10 billion, meaning that the hedge fund makes $10 billion in profits whilst only paying a small amount in premium. Therefore, debt default is not only a desired outcome, it is an outcome that financiers are banking on. Consequently, these hedge funds and investment vultures bet on the collapse of economies that are drenched in dollar-ridden debt in order to generate mass profits, whilst buying out the debt of weaker states in the global south for nothing, and then using the instability of the markets that they created to demand higher yields on their investment due to perceived risk. All these mechanisms permit the financial class to make billions in profits, whilst austerity is imposed on the working class in the US and the dollar-denominated debt-ridden global south. Simultaneously, this increases the stock value of the financial giants whilst they monopolize the markets and global wealth, consolidating their autocracy over the working class. Additionally, as dollar-denominated countries risk default as a result of Trump's tariffs, the capitalist ruling class hopes to obstruct the global south from having the economic autonomy and ability to work with China on projects such as the BRI, as the objective is to strain their financial ability to do so via the austerity that Western creditors shall impose on these nations. Furthermore, according to the Wall Street Journal, this is already a demand that the Trump administration is imposing on countries that are trying to negotiate with the US in order to avoid tariffs. However, what the US fails to apprehend is that China is the world's industrial superpower, with a growth rate in the first quarter of 2025 alone at 5.4%, and is the number one trading partner for more than 120 countries around the world, leading in research and development in multiple industries, AI and high tech now being one of those industries. Asking countries of the world to therefore limit their trade with the world's main supplier and innovator when the US lacks the industrial capacity to make up for the loss of the Chinese market is simply a ridiculous and desperate endeavor that shall merely isolate the US in the long run, diminishing its power and influence substantially. Just this month, Saudi Arabia and China signed an EV development deal, marking one of the many bilateral trade and currency cooperations established between the two countries in recent years, a vital development, as Saudi Arabia, that has long been one of the pillars of Western imperialism, is also opting to diversify its international trade and commerce away from the United States. In fact, the United States itself is reliant on the Chinese market, which is why Trump excluded tariffs on imports on smartphones and laptops from China. This is because 80% of smartphones and laptops in the US market are actually imported from China. To be exact, smartphones and laptops are the two top imported products from China, making up around 35% of the total Chinese imports to the US. Now, given that the US makes up 14% of China's exports, by removing smartphones and laptops, this brings us down to 9.7%, meaning that Trump has imposed a 145% tariff on 9.7% of China's overall exports, which China can make up by entering into the other bilateral trading agreements with other countries. However, the fact that Trump removed smartphones and laptop imports from the stringent tariffs on China and has now even overtly stated that he plans on reducing the tariffs on China substantially just 1 week after he announced them proves that the US does not hold the leveraging power it is attempting to portray that it does. And more so, it demonstrates that these tariffs were a tool used to generate market instability. This is also precisely the reason why Trump quickly issued a temporary pause on the tariffs he imposed on 90 countries around the globe. That being market instability, a market crash, and potential recession, so as to allow the world's largest corporations and ruling class to consolidate market power, maximize profits, and bleed out the working class. Consequently, as the US continues to abuse whatever power it has left, countries of the global south shall further be incentivized to increase collaboration with China, whilst also moving away from the unstable dollar as a means to break free from the chains of their debt bondage to the capitalist class. This shall speed up the process and desire to de-dollarize as a matter of national survival. This is, of course, rather ironic, as Trump has threatened that if any country chooses to de-dollarize, he shall impose tariffs on them, inadvertently bringing about the precise result he's attempting to deter. Now, speaking of financialization and the dollarization of the world economy, this brings me to another reason as to why the tariffs are a means to further fuel the financial class, and that is that the US must have a trade deficit in order to maintain its dollar dominance. In fact, the US trade deficit and dollar hegemony reinforce each other, a dynamic called the Triffin dilemma. Now, what does this mean? It means that for the US dollar to function as the global reserve currency, the world needs a constant supply of dollars, which thus requires the US to run a persistent trade deficit so as to flood the world with dollars. Therefore, the US acts as the world's consumer, absorbing excess production from export driven economies such as China, Germany, and Japan in order to sustain the dollarization of the global economy. A simple look at the US balance of payments between the 1970s to present exemplifies that the current account, which is the trade deficit, matches the capital account, which is the foreign investment surplus, but in reverse. Why? Because the money the US spends on imports is then returned to the US as foreign countries pay off debt or use their trade surplus to secure dollars by purchasing US Treasury bonds and investing in financial assets within the US so as to be able to engage in international trade and commerce, as the dollar is the global reserve currency. Therefore, in order to keep the dollar as a global reserve currency, the US must have a trade deficit. You cannot have one without the other. This is why Trump's tariffs are in no way meant to reindustrialize the US, nor should they be taken as being a matter of fact, for that would require the US to terminate its financialization, impose laws whereby the state would control capital, and not the other way around as it currently is. It would require reinvestment in industrialization, all of which would require the end of the dollarized global market that has for too long given the US what has been famously called exorbitant privilege, an imperialist project that has allowed the US to exploit the world without any consequences, exporting its inflation and crippling the world economy at will. This, therefore, yet again reaffirms that Trump's tariffs that he announces as fast as he pauses them are no more than a mechanism by which to unsettle the markets, driving out the weaker and smaller firms, allowing capital to monopolize their market share while sustaining their market value and making quadruple in profits. Simultaneously, it is a means to threaten the global south and further cripple them with debt, fueling the financial class whilst instigating global conflicts so as to eradicate excess capital, all of which are futile attempts to deter the inevitable demise of capitalism. These are some of the key objectives behind Trump's policies. Allowing vulture capital to parasitically absorb the market when the values of stocks and bonds fall, and then restoring the market once a significant portion of the market has been appropriated by the elite, because ultimately, capitalism is driven by the pursuit of persistent profit maximization rather than to meet the needs of society. Consequently, as there is not enough demand by which to maintain profitability, this leads to an overproduction crisis in the most Marxian sense that diminishes the rate of profits for corporations, their value and innovation, which is why financialization occurs in order to attempt to delay the inevitable collapse of capitalism. How does it do so? Well, financialization via debt bubbles and market speculation, stock buybacks, and other forms of asset price inflation artificially prop up demand, masking the overproduction crisis and stagnated growth. However, in the long run, the rise in unpayable debt and stock market bubbles that were used to camouflage the consumer demand slumps and capitalism's glutted markets will worsen the overproduction crisis and the tendency for the rate of profit to fall, leading to worsening crises. Why? Because credit doesn't solve overproduction. It merely socializes it, as the working class are made to suffer severe austerity in the form of welfare cuts and diminishing wages, whilst the private sector makes significant gains. And it does so by engaging in A, destructive crises to monopolize power, and B, authoritarian war economies that serve as a means to resuscitate demand by destroying excess capital and suppressing class struggle. This is in fact one of the many reasons as to why the capitalist war machine has systematically been instigating violent wars across the globe, from the Russia-Ukraine war to the potential war in Taiwan and Western Asia. That is, to destroy excess capital, ramp up demand, and to monopolize power via market appropriation and hegemony, whilst, of course, weakening their adversaries and absorbing their resources so as to sustain imperialism. This is precisely why regurgitating the narratives, such as the myopic notion that Israel is the sole cause of all evil, fails to assess the systemic root cause of the problems that are occurring around the world, and that is capitalism itself. However, as capitalism utilizes all its mechanisms to postpone its inevitable demise, it is actually accelerating it. By impoverishing the working class even more so and deteriorating their material conditions, this will only bring about a further slump in demand, meaning that it will not resolve the overproduction crisis. And the wars that they're instigating around the world will simply amplify that contradiction. It would be thus a fool's error to simply write off Trump's policies as merely the workings of a madman. Albeit to a certain extent there is some truth to that, there are key objectives within his policies that are geared towards servicing the interests of the ruling class, and a futile attempt to delay the demise of capitalism, which, as aforementioned, he is in fact accelerating. As Trump therefore continues the work of his predecessors, his seemingly erratic policies and demeanor, along with that of his entire administration, act as a distraction to what his underlying motives are. To the extent that Trump inadvertently admits that neoliberalism is the root cause for the deteriorating material conditions for the American working class, he appeals to the masses that have bona fide grievances with neoliberalism, and as such, uses this as a means to disorientate the public by claiming that their troubles will be resolved by imposing tariffs or by expelling migrants. Trump does this knowing full well that tariffs on their own are not enough to reindustrialize the US. Without ending the dollarization of the world market and without a powerful state to impose regulations that shall control capital, coercing it to reinvest in the sort of training, infrastructure, and research requisite to reindustrialize. Therefore, once again, it becomes lucid that these tariffs will do very little to bring business back to the US, which for the most part lacks a sort of skilled labor force, infrastructure, and investment in research and development to reindustrialize. One classic example of this is the semiconductor industry, which is a vital component to modern technology and daily life, as it is the foundation of nearly all electronic devices, whilst Taiwan makes up 65% of the world's semiconductor production, with China in second place at 16% and aiming for 70% by 2030. In a futile attempt to alter the statistic, Trump has threatened Taiwan with 100% tariffs, and although he has so far excluded tariffs on semiconductors, his administration has just announced that it is carrying out an investigation into imports from pharmaceuticals and semiconductors into the US as part of an attempt to impose tariffs on both sectors on the grounds of national security interests. Tariffs, however, are not the primary factor chip manufacturers consider when choosing where to locate new semiconductor fabs. Manufacturing semiconductors is perhaps the most complex, expensive engineering task humanity undertakes, with the most sophisticated semiconductor fabs costing over $30 billion to construct. So when making that investment, semiconductor manufacturers meticulously evaluate up to 500 factors. This would include labor talent, tax, trade, technology policies, as well as regulatory, environmental, and labor market conditions before making their decision. Additionally, materials that are necessary for the production of the semiconductor industry are sourced from over 50 different countries around the world, countries that the US plans on tariffing, thus making the production of semiconductors in the US all the more expensive and so less appealing for manufacturers to invest in. Therefore, even though Taiwan is attempting to circumvent Trump's tariffs by claiming it shall invest $100 billion in the US.
Today, Taiwan Semiconductor is announcing that they will be investing at least $100 billion in new capital in the United States over the next short period of time.
This would in fact do very little to alter the status quo of the United States production of semiconductors, as this amount would equate to the establishment of one or two semiconductor fabs at most that would take several years to construct, and with the high probability that its productive capacity will be limited due to the US's global tariffs, if they continue to proceed and are put in place, and lack of skilled labor force, among other factors. This, however, is the result of neoliberal globalization, as its objective was rooted in short-term profit maximization by exporting supply chains and production to cheaper countries for the purpose of sustaining high profit margins, and thus creating economies within the global south that are specialized in the production of goods and with an expertise labor force that simply outcompete the US. Consequently, from a cost-benefit analysis, moving industries to the US is simply put not worth it. Similarly, even if American tech industries start producing locally, such as Nvidia, who has announced that it will be building its AI supercomputers in the US for the first time ever, the US is still curtailed from becoming a leading competitor in the global market for the exact same reasons. And these are the contradictions of capitalism. Therefore, coercing the semiconductor industry to resettle in the US at this stage will merely increase the cost of tech globally. As the cost of production shall increase, it will most likely obstruct Taiwan's profitability, but that in the long run shall most likely favor China. Again, the contradictions of capitalism. Once again, it is clear that the tariffs will do little to reindustrialize the US, but rather, as the cost of tech shall increase globally, this will artificially increase the stock value and market cap of US tech corporations, which alongside the stock buybacks and the impacts of the tariffs on the global market, will further inflate the stock market bubble and wealth for the top 10%. However, these are, as always, short-term gains that are driven by profit and a desperate attempt for the capitalist class to save itself, which shall ultimately have the contrary effect. To conclude, it is clear that by imposing tariffs and preaching pseudo-anti-globalization rhetoric, Trump appeals to the average American, whilst his tariffs fluctuate the stock and bond markets in such a way so as to increase financialization by allowing the ruling class to capture more of the market, quadruple their profits, and advance asset price investment at the expense of whatever remains of the industrial sector within the US. These policies seek to bleed the American working class as well as the international working class, given the repercussions this shall have on the global economy. However, these short-term gains merely amplify the long-term collapse of capitalism, as the US has lost its industrial trade power due to financialization and thus its leverage, exporting its capabilities to the global south, who now more than ever understand the need to break free from the dollar, something that makes a superpower China all the more attractive as a partner. Consequently, Trump's half-truths complemented with his so-called authenticity and unfiltered delivery that opposes the traditional diplomatic etiquette of bourgeois politicians has deceived the working class into believing one of two things. Firstly, that Trump is an anti-establishment underdog, or secondly, that Trump, at the very least, is honest in his pursuits and thus exposes capital. However, I would argue that neither of these postulations are true. Following his first term and now in his second term, Trump has proved that he's very much part of the establishment. And similarly, he only exposes capital to the extent that he needs to, allowing him to distort masses by providing half-truths. If anything, Trump's antiques legitimize the Democratic Party, thus fueling the partisan diagesis of bourgeois democracy in the United States. Therefore, in both scenarios, Trump is a distraction that serves the system so far as he can, for ultimately, it shall fail either way.